SPACs, or special purpose acquisition companies, have become incredibly popular in recent years, raising over $83 billion in 2020, which outpaced all other IPOs last year and was up over 600% from 2019 figures, with just $13.6 billion raised across just 59 SPACs formed in that year. And with significant volatility in the markets still carrying over from 2020 and the long time frame of the traditional IPO process losing its appeal for many companies who are looking to go public in the near term, SPACs have continued their hot streak heading into 2021 with over $44 billion raised already in just the first 6 weeks of the new year across 146 SPACs, according to SPACInsider data. And with the surge of popularity in these special purpose acquisition companies right now, SPACs are starting to make waves in the commercial real estate space as well, with a few major players in the industry forming their own SPACs over the last 12 months, which could shake some things up in the real estate industry as a whole in the very near future. So in this video, we'll break down what these SPACs are, the specific companies that are moving into this space, and what this might mean for the real estate industry as a whole in 2021 and beyond. So if you haven't heard of the acronym SPAC before, this stands for Special Purpose Acquisition Company, which is essentially a shell company formed to raise money through an IPO with the goal of identifying another growing private company to merge with, taking that company public in the process. SPACs are formed as non-operational entities without assets, and when these companies are formed, they also generally don't disclose the company or companies they plan to merge with upon formation. Investors in these vehicles are essentially banking on the track record of the management team putting this SPAC together, also known as the sponsor, which is going to be the team responsible for finding a profitable deal and merging with a target private company. SPAC IPOs are often priced at a nominal value of $10 per share, and the money raised goes into an interest-bearing trust account until the management team finds a company to take public. And from there, the sponsor is on the clock once that capital is raised, usually with a 2-year deployment window being the norm to complete a transaction. And if a company isn't identified and a deal isn't completed at the end of that window, the SPAC structure will often call for the company's assets to be liquidated and invested capital plus accrued interest to be returned to investors. However, if a company is identified and the SPAC shareholders approve the deal, the investors in the company essentially have an option to purchase with the ability to either buy into the new company or back out and redeem their SPAC shares and have their original investment returned plus interest. Now, these vehicles have become incredibly popular lately across many different industries, but we've recently started to see this popularity catching on in the real estate space with some major players in the industry forming their own SPACs and getting into the game. Back in November of last year, we saw CBRE, the world's largest commercial real estate services and investment firm, form a SPAC raising $350 million to acquire an unnamed high-growth company. Tishman Speyer, one of the largest commercial property owners in the country with over 78 million square feet of assets under management, is on their second SPAC, with their first $300 million SPAC being used to take the smart lock maker Latch public, and the company announced late last month that they're looking to raise an additional $250 million for another SPAC to acquire a second high-growth Proptech company in the future. Crown Acquisitions, one of New York's largest retail landlords, recently announced a raise of $240 million for a SPAC focused again on acquiring a growing company within the PropTech space. Simon Property Group, one of the largest retail property owners in the country, filed to raise up to $300 million for a new SPAC earlier this month, focused on innovation in the retail sector specifically. And RXR Realty, a company that controls 26 million square feet of office space in New York City, announced earlier this month that they would be raising $250 million for a SPAC, again focused on the PropTech space. Fifth Wall Ventures, one of the industry's most prominent venture capital firms, closed a $347 million SPAC IPO earlier this month, which was almost a 40% upsizing from an original target of $250 million, another indicator of extremely strong investor demand. And even industry giant Sam Zell, billionaire founder and chairman of Equity Group Investments, has launched his own SPAC aimed at opportunities to apply technological advancement within the industrial product type specifically. So, with so much activity in this space among major real estate firms and some really big names in the industry, the question becomes from here, what does this all mean for real estate as a whole, and how does this affect you as an investor and or real estate professional trying to build a career in the industry? Well, first, one of the most glaring trends we're seeing right now in the SPAC space is that the vast majority of these real estate focused SPACs are aimed at acquiring companies in the Proptech space directly, continuing to heat up an area of the business that has already seen tremendous growth over the last few years. With many of these active companies entering the space having heavy asset concentrations in struggling asset classes like retail, office, and hospitality, many real estate firms could be using these vehicles to diversify away from being invested in real property exclusively and allocate a portion of their portfolio towards efforts to control the technology that's going to influence the space in the decade to come. This is also likely partially the product of so much dry powder out in the market right now, looking to find value in a new type of investment vehicle that just doesn't exist in traditional paper assets and fee simple real estate ownership today. With the hottest property types in real estate like multifamily and industrial really fully priced right now, and companies and individual investors struggling to find value in traditional real estate investments, shifting to a higher risk, higher reward opportunity, leveraging operational expertise could potentially be a profitable move for many of these companies willing to take a swing at something new in this environment. Like I mentioned in a video a few months ago, I see PropTech as a huge opportunity right now from a real estate career perspective, and with the number of real estate SPACs rising at such a rapid pace, and these management groups being on the clock to take a company public in the short term, valuations for these PropTech firms are likely going to just continue to rise, and there's going to be more and more opportunities to either cash out with an equity stake within a PropTech focused firm as an early employee, or to create your own PropTech company to solve tech inefficiencies that still exist in the real estate industry today. And second, on the flip side of the opportunity that might come out of this activity we're seeing right now in the space, the meteoric rise that is occurring in SPACs today should also be something to be cautious about. After all, SPACs are just another investment vehicle, and even though they may be quicker to execute on with less cumbersome filing requirements and regulatory red tape, that doesn't necessarily mean that these are all profitable for retail investors. In fact, according to a study done by investment research firm Renaissance Capital that took a look at SPAC performance between the beginning of 2015 and the fall of 2020, only 93 of the 313 SPAC IPOs during that time, or 29.7%, had completed mergers and taken company public since inception. And of those 93 companies that did complete mergers, most of these investors in these SPACs actually lost money, with common shares of these stocks seeing an average loss of 9.6% and a median loss of 29.1% during that time period. And even with so much hype around these investment vehicles, this does make sense since SPAC sponsors are heavily incentivized to get a deal done within a 2-year period, even if that might mean overpaying for a company being acquired. As part of the common SPAC deal structure, most sponsors are going to receive a 20% ownership position in the company they take public, often referred to as the promote on the deal, diluting shareholder ownership interest from the time the merger with the new company is complete. And this might sound very similar to the promoted interest in a real estate deal, but with the exception that in many real estate partnership structures, the promoted interest is only earned on profits over and above a certain return hurdle after the deal has been sold, not an upfront transfer of equity interest in the property, even before the sponsor has proven the investment's profitability in the future. And this dilution of equity interest was actually quantified in even more detail in a November 2020 paper authored by Stanford and NYU law professors that studied all 47 SPACs that had merged between January 2019 and June of 2020. The report found that although SPACs generally raise $10 per share from investors in their IPOs, by the time the median SPAC merges with a target company, the entity holds just $6.67 in cash for each outstanding share. The study also found that SPAC share values tend to drop by 1/3 or more within a year following the merger, with the median return for a SPAC 3 months post-merger for these 47 companies at negative 14.5%, 6 months post-merger at negative 23.8%, and 12 months post-merger at negative 65.3%. So the bottom line is, for the real estate industry, there definitely are opportunities and there will be winners in this space, but just like any other investment vehicle, it's important to really dig into the management team and the financials of these companies being taken public by these SPACs, rather than just making the assumption that all SPACs will be profitable because of this structure. And in the industry as a whole, this could lead to a consolidation of companies, an even bigger infusion of capital into the Proptech space, and as a result of this, a continued acceleration of technology adoption in real estate across the board, and more efficient property acquisition and management as a result of these changes. So if you've heard about SPACs lately and all the hype surrounding them, I hope this was helpful in understanding both what these are and how these might impact the real estate industry. And if you're looking to break into the industry and capitalize on all of the changes that are happening so quickly in the business today, make sure to check out Break Into CRE Academy, which is going to give you instant access to a full video library of courses on real estate financial modeling and analysis, pre-built financial models and Excel training files, and additional one-on-one email-based career coaching to get your questions answered every step of the way. So I hope this was helpful, guys. Let me know your thoughts on SPACs in the comments below and the effects that they might have on the real estate industry going forward. And if you like this video and want to see more content like this, make sure to like the video to let me know and subscribe to the channel so you don't miss any new content as soon as it's posted. So as always, guys, thanks so much for watching. I hope this was helpful, and I'll see you in the next video.